Hi everyone, Cassandra Hammond here, your queen of wealth optimization, and I'm on the phone right now with my partner John Duncan, the Uncommon Advisor, and we are with Gold Leaf Advisory. And today we are going to be doing a webinar in regards to your deferred retirement accounts, which includes 401ks, SEPs, IRAs, and so forth. So these are accounts that you are saving on taxes now, but you're going to have to be paying taxes on the money later in retirement. Now, we have some shocking information for all of you out there, and I highly recommend that if you own one of these accounts, you pay attention to the following information. So without further ado, John, take it away.
Okay, thanks, Cassandra. Can you see my screen on your end?
Yes, I can.
Okay, what we're looking at here is the tax history in the United States on the top tax brackets in America. And as you can see, it starts in 1913 because that was the first year that we had income tax on our earnings. So basically, I'm just going to cover a quick highlight here. As you can see, tax rates have been as high as 94%, and as low as when it first began as a temporary tax, 7%. But as you can see, with different things that have happened, and I'll click events here, this was World War I, the stock market crash, the Great Depression. You can see with economic or worldwide or country events, you see that the tax rates change on a regular basis. And what we're going to talk about today is, if you look out here, you can see we're getting closer to today. And we're going to talk about what does that mean for somebody that has money in a 401k, an IRA, a SEP, basically any deferred plan where the taxes have not been paid. And so with this, we're going to look at an example of an account balance of $500,000. And we're going to look at, with my little arrow over here, we can look at different rates. Like if you look at today's rate, if you were to cash out a $500,000 IRA or 401k, just so you can understand this chart or the calculator here, I mean 40%. At 39%, most people actually look at their statement, see 500,000, and oh my gosh, I've got 500,000. But in reality, because it's a deferred account, your share as the owner of the 500,000 is 305. While the IRS, your partner in this account, is due 195,000.
Wow, that's a lot of money.
It's a lot of money. It's almost 40% of the account, and at the same time, we're not counting. You're in California there, Cassandra. I mean, you've got to add state tax on top of this. But what I wanted to talk about with this particular slide today is the simple fact that people are very concerned about, well, I need to put money back, and a lot of CPAs will tell you, you need to load up your 401k, load up your SEPs. And the issue with that I have with that is just looking at these tax rates, you can see a lot of them are much higher than they are today. And by the way, the average, if you added up all the last 100 years, the average highest tax bracket is 58.61%, which we're quite a ways from that at this point in time. The question is simply, should I be putting a bunch of money into deferred accounts at this point in the game? And what is the net effect on my account? And that's what this little lever is. What if you were deferring today and when you started to take it out, it went back to the average? Look at this. Instead of your share being almost 300,000, now it's 205, and the IRS gets
They're getting more
than you are. Now, why are we concerned about tax rates possibly going up? Another piece that I want to share briefly here is a place that everyone that watches this can go is the usdebtclock.org. And basically this shows how much money's coming in, what the national debt is, and so forth. What I like on this, I mean, as an information source, it shows that we're $18 trillion in the hole right now as a country. But we can actually look at this and say, well, what was it 3 years ago? It was 15 trillion. So we're going at $1 trillion a year clip right now of debt spending from our government. Well, there's going to be a point where the books have to be settled, and that's how does the government bring in money? It's through revenue. And as you can see, through time, they have, in fact, raised rates significantly in our history. So this isn't something that would be a new thing if they raised rates significantly. It's already happened before. So the bottom line is this. As you can see here, if the rates went sky high, their percentage goes sky high. Or in other words, the amount you owe goes really high. The only time that you actually win in a deferred count is if the tax rates when you take the money out actually go lower. And that really does apply usually for people that are making in the 30 to 60, maybe 70,000 a year range. People that are earning over, say, 70,000 a year, when they retire, generally their tax rate does not drop, and they are affected by increases in the tax rate. What I mean by that is they may be deferring at one rate and in the future be paying an even higher rate, which makes no sense whatsoever. So this is an inherent tax risk that is basically something that no one has a crystal ball. Your CPA, your financial person, no one has a crystal ball on what tax rates will be in the future. But with the debt of the country going up at almost, in some cases over $1 trillion a year, we believe that it makes good sense to at least diversify some of this risk. And there are other programs that are available that will make this risk minimized or eliminated altogether. So that's all I wanted to cover today. Did you want to summarize that, Cassandra?
Sure, John. So what you're saying is basically that we don't know what the tax rate is going to be in the future. So, I mean, it could possibly be higher. Most likely it will. And that could really affect how much money we're giving to the IRS in our retirement.
That is true.
Yes, and I think that's really disturbing, honestly.
Well, the point is that this is something that when you're looking at your investments and trying to figure out where to put money, you're trying to figure out how to grow it. This is talking about a risk that most advisors and tax professionals know about, but it isn't really talked about. But with this history on this chart, it's plain to see that the government can and will, when needed, increase rates substantially. And that can drastically change the value of your account.
Right. Well, thank you, John, for the information. I'm sure this is really resonating with a lot of people out there. So once again, John Duncan and Cassandra Hammond with Gold Leaf Advisory, bringing you the latest, the greatest, and the dirty when it comes to money. Thanks, John.
Thank you.